Hi guys, so I welcome you all to today's lecture under the fast track series for RBI Grade B 2018, which has been brought to you guys by EduTap. So we have been continuing this series for a while now, and we have discussed many different aspects relating to our examination. We have now attained a comprehensive understanding of the ESI and FM portion, and we have also covered most of the current affairs for our examination. So now in this particular video, we are going to go back to some of the important concepts of finance and focus on them from examination point of view. Now we have been working in this direction for the past few years, and we have been blessed with some of the very amazing results in the past few years. Now in RBI Grade B 2017 results, 124 of our students, they reached the interview stage, and 27 of the students, they made it to the final list. Now in case you need to know more, you have any query, you can always visit our website, which is www.edutap.co.in, or you can drop us a mail at deepak@edutap.co.in, or you can call us at 8146-207-241. So let us start our discussion on some of the very important questions on finance. So here's the first question for you guys. In which of the following cases NPV and IRR methods of capital budgeting, they are going to give conflicting results? So it is about the methods NPV and IRR, and when they are going to give us conflicting results. That is, when NPV is going to say, okay, you should accept and go for the project A, but IRR would say, no, the project B is better. So what are those cases in which this kind of scenario is going to happen? Options are: cash flow pattern of both the projects differ, initial investments differ, projects have different expected lives, all of the above, or none of the above. So friends, to know about this, to be able to solve this question, we must be having understanding about NPV and IRR, and not just the basic understanding. We must be thorough about the concepts of both. So by now I feel that we are very much clear with the concepts of NPV and IRR. Let's just quickly revise those concepts. Now if we talk about NPV, NPV is net present value. So NPV is nothing but net present value. So its meaning is hidden in the name itself, that what are you doing? You are finding net present value of the cash flows which are going to occur in future. So there is some investment which you are making, and you are getting some cash inflows in the future time period, and you discount those cash flows, and there is a discounting rate at which the cash flows are discounted, and you arrive at the present value of the inflows, and you subtract the initial outflow or the present value of outflow, you get the net present value. And if your net present value is more than 0, you accept the project, but if your net present value is less than 0, you reject that project. Now in case of IRR, what we are trying to do? We are trying to calculate a rate of return. We are trying to find the internal rate of return. So what do? We find the present value of cash inflows, and we equate it with the initial cash outflow or the present value of cash outflows. So when we equate the two, we try to find the rate. We try to find the R, which is IRR, at which these two are equal. And if this rate is greater than our cost of capital or the discounting rate which is given to us, we accept that particular project, and if it is not so, we reject that particular project. So this is the basic idea behind NPV and IRR. Now there may be some cases when the NPV and IRR, they may give contradictory opinion. So let us quickly see these cases. So the first one is when the cash flow pattern of both the projects differ. So if the cash flow pattern of the projects differ, that is, for one project cash flows are increasing, but for the other they are decreasing. So both these formulas, they involve some technical calculations or some complex mathematical calculations, and it may happen that the result which we get from both these methods is not commensurate, it is contradictory. In the second case, if the initial investments differ, and there is, say, difference in the type of scale of the investment. For example, if the initial investment for project A is rupees 1000, while for the project B it is rupees 1 lakh. So it is a difference of sort of a scale, and there is very much difference between the two. So it may happen that the results may be contradictory. Also, the projects may be having different expected life. So if we say the project of life of project A is 1 year, but of B is 5 years, it may happen that both these methods may give contradictory results. So now we are not going into too much technical details of why this kind of differences occur, and it's not the time to get into those details. We just need to remember these, that sometimes there is a contradictory opinion, and these are broadly those cases in which there is this contradictory opinion. Now, the moot question here is, what shall we do if there is a contradictory opinion? If there is a conflict between NPV and IRR, which one should we choose? Now NPV is saying, okay, choose me, but IRR is saying you should choose me. Now you have to weigh the merits and demerits of both these methods and find out the appropriate method for your answer. So the answer lies in the fact that you should choose that project which has higher NPV. So we have to give preference to the NPV over IRR. So we have to give the preference to NPV, because NPV, quite simply in raw language, it makes you richer. NPV is net present value. If the NPV is rupees 1 lakh, it means that you are earning on that project rupees 1 lakh. If you talk about IRR, it is simply a rate. It maybe say simply 12% rate. So 12% does not appeal to us, but 1 lakh rupees, if it says that 1 lakh will be in your pocket by following this project, it appeals to us. It increases our wealth. It makes us richer. So hence we will be taking up that project which has higher NPV. So we will employ NPV method because it is realistic. It is a better indicator of profitability and shareholder wealth, and it will give us an accurate picture of whether we should go with the projects or not. So now we can easily answer this question, that in all of these cases, so in all these scenarios which we have discussed, the NPV and IRR, they are going to give contradictory results. So the answer is option number D, all of the above. So now let's move to the next question. Dash leverage measures how a percentage change in sales from the current level will affect company's operating profits. So we are being asked about the leverage ratios in this particular question. Options are operating, financial, combined, all of the above, or none of the above. So to answer this question, we must be having some basic understanding about the concept of leverage in finance. Now the concept of leverage in finance says that the object of application of which is to make gains which are higher as compared to the fixed charges that you are paying. So if you have some fixed charge, but by increasing that particular fixed charge by only some amount, you can increase your revenues by a higher amount. This is the concept of leverage in finance. Now there are three types of leverage if we talk about the types of leverage in finance, and these are operating, financial, and combined. Now first one is operating. Now operating leverage, it says firm's ability to use fixed operating cost. This is the key word here, fixed operating cost, to magnify effects of changes in sales on its operating profits. So what happens is, every firm has some variable cost and it has some fixed cost. Now variable cost is going to rise as you increase your production level, but fixed cost is going to remain the same. It is going to remain constant. So what do? You try to increase your sales volume, and since your fixed cost remains the same, you will be earning higher amount of revenue. This is what you are trying to do in operating leverage. In case of financial leverage, what we do? We try to use fixed financial charges. So for example, if we have some debt in the firm, we have obtained some loan, we will only be paying a fixed rate of interest, say of 8% on that loan. And if you are able to generate higher earnings from that particular debt, all the higher surplus belongs to you or the shareholders. So this means by paying only a fixed portion on your debt, you can increase your revenues to the shareholders. So this is the concept of financial leverage. And when we talk about the combined leverage, this means operating plus financial combined. Now let's learn more about the operating leverage, because it's the one which is being asked in the question. So operating leverage, it tells us how the increase in volumes will increase the profitability of the firm. So if we increase the number of units sold, how can we increase the profitability of the firm? Let us take this example here. So we have this example here. In scenario 1, the number of units sold are 1000, and we have increased this particular sales by 40%. So it has now become 1400. Now if we'll take the sales price as rupees 10 per unit, then in the first case the total sale would be 10,000, and in the second one they are going to be 14,000, And if we take the variable cost to be 7 per unit, then in the first case it is going to be 7,000 and in the second 9,800. So remember we talked about that some costs are fixed and some are variable. So here we have talked about variable. Now if we subtract this variable cost from our sales revenue, we get this contribution which you are getting. So if we talk about this particular figure, it is 3,000 for scenario 1 and 4,200 for scenario 2. Now here comes the main change. So this is the key figure here, fixed cost. Now fixed cost is fixed. Its name only says that it is going to remain fixed, but your contribution is rising with the increase in the volume. So you can get the benefit of the fixed nature of this particular fixed cost for earning more revenues. So if we subtract this fixed cost in scenario 1, our EBIT, earnings before interest and tax, or simply operating profits, they are 2,000, and in the second case they are 3,200. So here the operating profits, they have increased by, if we talk in technical terms, they have increased by 60%. So we increased our sales only by 40% and our operating profits, they increased by 60%. This is nothing. This is the concept of operating leverage. This is the degree of operating leverage. So in this case, the sale increased by 40%, but the operating profits increased by 60%. And if we are asked to compute the degree of operating leverage, there's a very simple formula to calculate it. Percentage change in operating profits divided by percentage change in sales. So it would be 60 by 40 or 1.5. So if your sales increase by 1, your operating profits, they are going to increase by 1.5. So this is the crux of this particular formula. So now we can easily answer this question that it is the operating leverage. It is the operating leverage which measures how the change in sales are going to impact the operating profits of the company. So answer is going to be option number A here. Now let's move to the third question. A company issues 1 lakh 10% preference shares of rupees 10 each. Calculate the cost of preference capital if it is redeemable after 10 years at a 5% premium. So in this case, we are being told that the company has issued this preference share capital and it is to be redeemed at 5% premium after 10 years. We have to find out the cost of this preference issue. Now, if we just look at it vaguely, it may seem that the cost is 10% because the company has to pay 10% dividend on those preference shares. But there is a hidden point in this question that they are to be redeemed at a 5% premium. So you do not have to pay just 10% dividend to them. You also have to pay extra 5%. And this has to be paid at the time of when you are paying their actual principal amount, when you are redeeming those preference shares. So in raw terms, in layman terms, the cost of preference share will be greater than 10%. This is quite clear to us from simply reading this question. And this totally eliminates the first two options. So if you look at the first two options, they are 8.45 and 9.23%. So you are left with only two options, 10.24% and 11.69%. So if you have to just take a guess, you are not able to go forward due to any paucity of time in the examination. You can simply take a guess by using this particular scenario. And if you were to just take a guess and you'd feel like if the premium is only 5%, it should be slightly higher than 10%. You should go with this 10.24%. Now let's move forward and learn how to calculate this. Now, when we talk about the cost of preference share capital, now when we talk about the capital structure of the company, the capital structure of the company broadly comprises of two kinds of shares. One is the equity shares and the other one is the preference shares. Equity shares are the true owners. Preference shares, they are hybrid kind of owners in which they are getting fixed returns and their voting rights and their some other rights, they are not as equal to the equity shares. Now if we talk about the cost of preference shares, they can either be irredeemable. Irredeemable are those which you do not have to repay. So you do not have to repay these preference shares. But in case of next is the category of redeemable preference share. This is not irredeemable, this is redeemable preference share. Now in case of redeemable preference share, you have to repay them at a certain point of time in future. So you have to repay them and you have to find that cost which you are incurring of issuing those preference shares. So there is a simple formula for calculating this cost of redeemable preference shares, and this is very much similar to the formula of cost of debt. So if we are aware about this formula, this is going to be really easy for us. Now simply the difference is going to be in the tax component because the tax benefits are not available for preference shares. So the shortcut formula says that cost of preference share is equal to dividend payment. the dividend which you are paying plus the higher amount which you have to pay at the time of redemption, that is maturity value minus the issue price divided by the number of years for which you have issued those preference shares, and this has to be divided by the average of the issue price and the average of the issue price and redemption price. So this is a very simple formula, very similar to the cost of debt wala formula. So now let's try to solve the problem which were given. A company issues 1,10% preference shares. So here the dividend payment is going to be 10% of the issue price, which is rupees 10. So it is going to be only rupees 1. And they are redeemable after 10 years. So here the term is going to be 10 years. Issue price is going to be rupees 10. And the maturity value is going to be 10 plus 5%. So it is going to be around 10.5. So if we apply this particular shortcut formula, 1, which is the dividend, plus 10.5 minus 10 divided by 10 divided by the average of the issue price and the redemption price. So it is going to be like this, and if we try to solve this, it is going to be 10.24%. So now we can easily answer this question, that the answer to this problem is going to be option number C, that is 10.24%. And if you remember, this is what we discussed when we were just making a guess out of what is going to be the answer. Now move to the next question. Dash option gives the holder the right to buy an asset at a certain price within a specified period of time. Options are call option, put option, bull, bear, or none of the above. So if you are having a basic idea about the concept of options, then you can simply eliminate the option number C and D, because these are the two major types of options which are there, call and put. So now when you talk about the options, they are a part of derivatives. So we have discussed derivatives many a times now, and we are not going into much details. Quite simply, the derivatives, they derive their value from some underlying asset, and that underlying asset can be either shares, it can be either currency, or any commodity, or even interest rates. And there are different types of derivatives. There are futures, there are options, there are forwards, and there are swaps. Now for the purpose of this question, our focus is going to be on options. Now when we talk about option, an option is a contract that gives the buyer the right but not the obligation to buy or sell an underlying asset at a specific price on or before a certain date. So to understand this, let us quickly change this word. You can understand this better if we write this holder. So an option is a contract that gives the holder the right. So if there is this person and he is the holder of an option, so this person has the right that he can buy or sell. So if this person say he has a scooter, so if this person has a scooter, then this person can buy or sell, then that person can sell that particular scooter at a specific price at a specific date in the future. So he decides only now that, okay, I'll sell this scooter to you for rupees 10,000, and that other person also agrees. So he's getting this right. And will he simply get this right? No, he will not simply get this right. He will get this right only if he makes some premium, if he only makes some payment, and that is in the form of option premium. So this is the concept of options. Now options can be of two types. They can be either call option or it can be either put option. Now let us learn about these two options. Now a call option is one which gives the holder the right to buy. So if there is this person, he wants to buy the shares of Reliance. So he wants to buy the shares of Reliance, and what this person feels that the price of Reliance shares is going to rise in the future. So what he tries to do, he tries to minimize this risk of rising price in the future by fixing that particular price right now. And what he does, he goes to this another person and he says to this another person, I am paying you rupees 100 and I want you to fix this price for me of Reliance shares at rupees 1000 at a future date, say the next of the month. So that person feels, I don't think the price of Reliance is going to rise at all. I am getting this rupees 100 and I may not have to even sell those shares to the other person for rupees 1000. So I feel that this is a gain for me. So due to their different perceptions of the market, they are able to enter into this transaction. So this person has acquired the right to buy without any obligation. There is not any obligation on this person that he has to buy because he has paid this option premium. So the person has a right to buy within a specified period of time an asset at a certain price. So they are similar to taking a long option on a stock because you feel that the price of the share is going to rise. Now put option is something different. Now put option is similar to the one we discussed in the last scooter example. If a person wants to sell his scooter and he fixes that particular price in advance, this is put option. So this is an agreement to sell without any obligation at a specific amount at a specified price at a future date. So this is the put option. So this is the difference between the call option and the put option. So now for the purpose of this question, the answer is going to be call option because it is asking the right to buy. The right to buy is call option and the right to sell is put option. So answer is option A. Now let's move to the next question. Dash ratio aims to ensure that a bank maintains an adequate level of unencumbered high quality liquid assets that can be converted into cash to meet its liquidity needs for a 30 calendar day time horizon. Options are liquidity coverage ratio, net stable funding ratio, capital adequacy ratio, cash reserve ratio, or none of the above. So to answer this question, we must be aware about a particular concept of liquidity coverage ratio. So there was this notification which was in news recently with the relating to the concept of liquidity coverage ratio, and the notification, it said that RBI has raised the carve out for liquidity coverage ratio from SLR, and we were being given some analysis out of it. So let's understand this concept of liquidity coverage ratio. So liquidity coverage ratio, it aims to ensure that banks should maintain adequate level of unencumbered. So unencumbered means without any encumbrances, without any obligations. You have to maintain high quality liquid assets, the assets which should be readily converted into cash so that you can meet any unforeseen requirement for a 30 calendar day time horizon. So you have to maintain adequate liquid reserves to maintain any unforeseen scenario for a 30 calendar day time horizon. And if you talk about mathematically, it is this stock of highly liquid assets divided by total net cash outflows over the next 30 calendar days. It should be greater than equal to 100%, and it was to be achieved in a phased manner as per the regulations of RBI. So quite simply, your stock of high quality liquid assets, the numerator, it should be higher than the denominator, that is net cash outflows over the next 30 calendar days. And there was this notification in the news recently, and it talked about the high quality liquid assets, and for the purpose of computing them, it said that we should consider these in computing this liquidity coverage ratio for high quality liquid assets. And it says that the government securities in excess of the minimum SLR requirement would be included, and within that particular SLR requirement there were these two categories, and in one of the categories, that is under the facility to avail liquidity for a liquidity coverage ratio, there was this earlier 9% and now this has been made 11% of the bank's NDTL. Now we do not need to go much into these technical details, and these already have been discussed by us in a separate video. So we just have to remember that there was some increase in this carve out from this SLR requirement with regard to liquidity coverage ratio. So now we can easily answer this question that the liquidity coverage ratio, it aims to ensure that banks have adequate high quality liquid assets so that they can meet any unforeseen scenario for a 30 calendar day time horizon. So answer will be option number A. So guys, this was all about our discussion on some of the very important MCQs on finance. Thank you guys. If you found this video useful, please like the same and share it with your friends. And for more similar videos, please subscribe to our channel on YouTube. Thank you.